Welcome to the Deep Dive. You send us what you're curious about, and we extract the core insights to get you up to speed fast.
That's the idea.
Today, we're tackling a pretty big one. Wealth preservation amidst, well, some significant global shifts. One of you shared excerpts from a Hidden Forces YouTube video featuring economic historian Russell Napier.
Right, the one titled Wealth Preservation During a Fourth Turning.
Exactly.
Okay, so our mission for you today is to really try and understand the economic, political, and geopolitical fault lines Napier identifies in this chat he had with Dimitri Kofinas and Grant Williams.
Yeah, we want to go beyond just, summarizing his points.
Right. We want to truly grasp the implications, particularly for how you might think about safeguarding wealth in this evolving landscape.
Absolutely. Because, what Napier lays out here, it's basically a potential sea change.
Mm-hmm.
The end of a 30-year global order and the rise of what he calls national capitalism, plus an era of financial repression. Definitely. Okay, so to get to the heart of this, where does Napier say the fundamental drivers? Where do they come from? What's causing these profound shifts?
Well, he argues pretty strongly that we need to look at the underlying global imbalances as the fundamental disease driving things.
Not the symptoms.
Exactly, not getting distracted by the various symptoms we see in the headlines day to day. Think of it like diagnosing an illness, you have to find the root cause, right? Not just treat the fever.
Okay, that makes sense. So what are these key imbalances that Napier points to as the root of the problem?
He identifies several critical ones. First, the developed world's total non-financial debt relative to the size of its economies. The GDP is at a historical high.
Right, a massive weight the system has to carry.
Exactly, and this includes debt held by households, businesses, and governments. A high level like this, well, it can act as a significant drag on future growth.
Okay, got it. That's one. What else is on his list of these fundamental imbalances?
Second is the significant wealth inequality we see, particularly in the developed world. Napier really stresses that this isn't just an economic issue, it's politically explosive.
You see it feeding into various social and political movements.
For sure. Then we have the persistent trade imbalances between nations. Now, in a world where capital can flow pretty freely across borders, Napier reminds us that these trade imbalances are intrinsically linked to capital imbalances.
Right. Two sides of the same coin.
Precisely. If one country consistently buys more than it sells, that difference has to be financed by capital flows from somewhere else.
The deficit has to be funded.
Okay.
And the final key imbalance he highlights.
That would be China's exchange rate policy over the years. Napier's view is that this policy has been a major, maybe even unintended, driver of these broader global imbalances.
Unintended.
Yeah, he's careful to say it wasn't necessarily some deliberate strategy to create these imbalances, but more a consequence of their chosen exchange rate setup over a really long period.
Okay, so these imbalances have built up, and Napier argues they now need to be corrected. Or unwound, as he puts it. He even mentions Donald Trump trying to address them.
Yes, Napier points out that Trump's focus seemed to be on how these imbalances were hitting, say, the American blue-collar worker.
Through trade deficits, wealth distribution.
Exactly. But the crucial point Napier makes is that these imbalances are really deeply entrenched, and unwinding them is the central economic challenge we're grappling with right now.
Now, for you, our listener, the big question is likely. If these imbalances are unwinding, what does that actually mean for your financial well-being? Napier talks about potential pain.
Yeah, he doesn't really shy away from that. He says this unwinding is likely to be painful, especially for savers. He draws a historical parallel, actually, to the era of financial repression after World War II.
Okay, how so?
Well, in that period, governments deliberately kept interest rates low, often below inflation.
Which erodes the real value of savings.
Right, especially savings held in bonds. But interestingly, Napier notes that during that time, blue-collar workers and maybe younger generations often fared relatively better.
Why was that?
Due to things like rising wages, government support, maybe debt being inflated away.
So a situation where savers might feel the pinch, but potentially not everyone. What if the pain is widespread, though?
That's where Napier sees a significant risk of social fragmentation. If the pain of this rebalancing hits hard, not just for savers, but also for, a broad segment of the working population, the social and political fallout could be much more severe.
Mm-hmm.
He contrasts traditional saving and portfolio management in this kind of environment with this idea of regulatory arbitrage.
Regulatory arbitrage. What does that mean exactly?
Basically, finding clever ways to navigate the new rules, the new regulatory landscape to potentially preserve capital. It's a very different approach than just relying on standard investment strategies.
Right. Okay. That sounds like a much more active and potentially complex way to manage your money. Now, Napier also discusses the end of the non-system. What exactly is he referring to there?
He's talking about the global economic and monetary arrangements that sort of emerged organically after the Bretton Woods system effectively collapsed in the early 1970s.
When the U.S. dollar wasn't linked to gold anymore.
Exactly. It wasn't a formally designed system, hence the term non-system, and Napier believes it's now basically reaching its natural end.
And he suggests that policy decisions, like, say, the ones we saw during the Trump administration, they're more symptoms of these deeper underlying forces,
Yeah.
not the primary drivers themselves.
Precisely. His argument is that political leaders are often reacting to these larger secular trends and imbalances rather than independently steering the ship, so to speak. He uses the Trump administration as an example, viewing its policies as a response to these more fundamental issues.
Okay, so what were the key features or mechanics of this non-system that Napier believes is now breaking down? What made it tick?
Well, in his view, a really crucial starting point was China's decision back in '94 to link its currency, the RMB, to the US dollar.
To make their exports more competitive.
Right. Then, following the Asian financial crisis in '97, '98, many other emerging market economies effectively did the same thing, tying their currencies to the dollar.
Okay.
This led to a massive buildup of U.S. dollar reserves in these countries, especially China, because they had to intervene in currency markets to keep those pegs stable.
And what did they do with all those dollars?
Well, these reserves were then often plowed back into developed world debt, particularly U.S. Treasury bonds. And that helped keep interest rates in places like the U.S. artificially low compared to economic growth.
Right, okay. Creating that divergence between the discount rate and the growth rate he mentions.
Exactly. I mean, this widening gap made borrowing cheaper, which encouraged more debt, more leverage, and it also helped push up asset prices.
And in China.
A significant chunk of this dollar inflow-fueled investment in manufacturing capacity all aimed at exports, which, just further exacerbated the trade imbalances.
So, when the Trump administration started focusing on trade deficits and slapping on tariffs, they were essentially taking aim at this whole interconnected system, attacking the whole setup, basically.
That's Napier's interpretation, yeah. By targeting trade, the intention was, well, to address and ultimately try to reduce these long-standing imbalances. But Napier believes that maybe the speed and scale of the potential capital flow responses weren't fully anticipated.
Because capital moves faster than goods.
Much faster. As he emphasizes, capital can zip across borders way more rapidly than trade flows can adjust.
Gotcha. And according to Napier, we've already seen evidence of these capital shifts happening in response to those policies.
Yes, he argues that the uncertainty and the perception of the U.S. as maybe a less reliable partner generated partly by that approach has already begun to make capital more hesitant to stay in or even flow into U.S. markets.
Shifting to those capital flows then, the conversation touches on a recent trend, maybe capital moving out of the U.S. and into Europe. Initially, people thought this was because of expected German spending or European defense budgets.
Right, that was the initial narrative.
But Napier adds another layer, doesn't he?
He agrees those factors, especially the shift in German fiscal policy, likely played a role. But he also really stresses the impact of the U.S.'s posture on the world stage just being seen as less predictable, less reliable as an ally.
So that uncertainty pushes capital away.
Napier suggests it contributed significantly to capital looking for other places to go.
He even brings up Japan as a potentially significant seller of U.S. assets. Why Japan specifically?
Well, Japan holds a huge amount of U.S. Treasury bonds, just massive amounts. Napier points to some initial data suggesting Japanese investors were indeed net sellers of these assets.
Interesting.
Yeah, indicating a potential shift in their investment strategy, perhaps partly driven by these global uncertainties. Interestingly, though, the initial effect in Europe wasn't a surge in bond yields, which you might expect.
With capital flowing in.
Right. Instead, yields actually came down initially, which sort of temporarily eased any pressure for European governments to, compel domestic capital to come home.
But he implies that this pressure for capital repatriation in Europe could return if their bond yields start to climb.
That's the logical conclusion, yeah. If European bond yields were to rise significantly, it could make their own government bonds more attractive to locals, and that might lead governments to encourage or maybe even require local capital to invest domestically.
Okay.
But Napier emphasizes that the initial capital outflow from the U.S. seemed more driven by this kind of flight from uncertainty linked to U.S. policy rather than just a sudden huge attraction to European
Right.
assets.
This segues into a really interesting point about unusual behavior in financial markets.
Yeah.
The dollar down, stocks down, bonds, U.S. Treasuries down, and gold up, all happening kind of at the same time. It's not the usual playbook.
No, it's definitely not. And he sees this breakdown in traditional asset correlations as a really significant indicator, a sign that we're in a period of fundamental structural change. He almost seems surprised that people are still expecting the old relationships to hold.
Hmm.
And maybe more profoundly, he highlights this growing unease about the safety of capital itself in the U.S. He mentions a question he got from someone well-informed over in Wales, asking about the safety of their assets held in America.
Wow, okay. That anecdote really drives the point home. So this shift in focus from just maximizing return on capital to prioritizing the return of capital, just making sure it's safe. That's a key element here.
Absolutely. I mean, when the fundamental security and stability of your capital become your primary worry, it naturally reshapes how you invest, and it disrupts those established patterns between different asset classes.
He draws a historical parallel.
Yeah, to the late 1960s. Another period when the existing global monetary system, the tail end of Bretton Woods, was kind of fracturing, leading to similar odd dislocations and asset correlations.
And the sophisticated algorithms, the machines managing so much money, based on those 30, 40-year historical relationships, they're likely to be caught off guard in this new environment.
Precisely. Their models are built on historical data that just might not be relevant anymore, which could lead to increased market volatility as they try to adjust to these new realities.
Makes sense.
Napier argues that global monetary systems tend to have a natural lifespan, maybe 30 to 40 years. And the one that took shape around 1994, it's now showing clear signs of breaking down. The critical thing, he advises, is to understand the underlying imbalances driving this and, well, position your investments to preserve purchasing power through this unwinding. Don't just try to time the short-term market swings based on outdated correlations.
Okay. The conversation then moves to the future of global currency systems. Napier actually posits the possibility of two major currency blocks emerging, one potentially dollar-based, the other involving China.
That's his core prediction, yeah. Although he admits it's still a point of debate. He believes that for any non-dollar bloc to gain real credibility and widespread use, it would likely need to incorporate a significant element of gold backing.
Gold. Why gold?
Well, he points out that while the Chinese renminbi has been open as a reserve currency for a while and it's used more in trade, its actual uptake by central banks as a major reserve asset is still pretty limited. Gold could lend it credibility.
What's his outlook for the U.S. dollar in this potential, split world?
Napier suggests that in a scenario he calls ex-China, basically, a Cold War-type separation of economic spheres, the U.S. dollar might, perhaps paradoxically, become even more dominant as the main reserve currency within its bloc.
But with a catch.
Yeah, a big one. He cautions that this dominance might come without the free and open capital flows that we've gotten used to over the last few decades.
He even brings up the historical example of the British pound sterling declining as a global reserve currency. What's the relevance there?
He references Catherine Schenk's work on sterling's decline to basically highlight that being the top dog reserve currency isn't always this exorbitant privilege, especially during big global shifts.
How so?
After World War II, the UK, as the former reserve currency holder, faced the burden of managing large capital outflows. They eventually had to bring in capital controls to stabilize their own financial system.
So the U.S. might face a similar situation down the road. What triggers does Napier see as potentially leading to capital controls in the U.S.?
He points to a sharp jump in U.S. Treasury bond yields, making it much more expensive for the government to finance its debt as a potential catalyst.
Okay, so borrowing costs spike.
Right. But he believes the initial response probably wouldn't be to stop foreign investors from pulling their money out.
Why not?
Because that would severely damage the dollar's standing as the global reserve currency. That's the nuclear option.
So what would they do first?
Instead, the first move would likely be to compel domestic financial institutions, think pension funds, insurance companies, to buy U.S. government bonds, a form of forced capital repatriation.
That's a crucial distinction, forcing domestic buying before restricting foreign selling.
Exactly. Restricting foreign capital flows is the last resort. likely only in a really dire situation. He also suggests that countries with large net international investment position deficits,
Meaning they owe more to foreigners than foreigners owe them.
right, like the US and potentially France, they might be more prone to considering restrictions on foreign capital outflows sooner than countries with big surpluses like Germany and Japan.
Okay, the conversation then shifts gear a bit to practical advice for businesses and investors on managing cash and inventory in this kind of deglobalizing world.
Yeah, for businesses, Napier recommends holding cash in the currencies where you'll actually need to spend it, and potentially increasing your domestic cash reserves just as a buffer against uncertainty.
Makes sense. And inventory.
He also points to this growing trend of businesses wanting to bring production and inventory closer to home, reshoring, basically, to cut the risks tied to complex, far-flung supply chains.
And these adjustments are happening fast.
He emphasizes that these shifts in cash management and where companies put their capital, they're likely happening even faster than the adjustments in international trade patterns themselves.
And the general uncertainty created by trade tensions and less reliable international partnerships, this leads to a more permanent reshaping of how businesses operate.
Absolutely. Once businesses feel the vulnerabilities of relying on distant, potentially unreliable partners and supply lines, they're probably less likely to just snap back to the old ways quickly, even if tariffs get rolled back. This fundamental realignment, supply chains, inventory, cash balances, is likely to be a pretty long-lasting consequence.
Napier also makes the point that America's stated desire for a smaller current account deficit, well, that inherently means it wants less capital flowing into the country, right?
Exactly. If you want to borrow less from the rest of the world, you need less foreign capital coming in to finance that borrowing.
So where does he see that capital potentially heading instead?
He suggests countries like Germany and Japan, which have historically been big exporters and thus net providers of capital, could become more attractive destinations for financial capital.
Okay.
He also draws a distinction between purely financial capital and more operational capital, noting that the trend of friendshoring, moving production to politically aligned countries, might even evolve further into more direct reshoring, as both China and the U.S. are seen as carrying increased geopolitical risks.
Right. The discussion acknowledges the rapid pace of global events, like the war in Ukraine, but it ultimately keeps the focus squarely on the U.S.-China relationship as the pivotal dynamic, doesn't it?
Yes, exactly. While events like the conflict in Ukraine are obviously hugely significant, Napier argues that the core driver of the major shifts we're discussing remains that complex, evolving relationship between the U.S. and China.
He touches on the debate about the Trump administration's motives.
Yeah, whether that assertive stance was a deliberate tactic to pressure allies to get tougher on China, but he notes there weren't many voices within that administration really pushing for a less confrontational approach.
So in Napier's view, the long-term impact of the Trump administration will largely be defined by how it affected the U.S.-China relationship.
That's his assessment, yeah. He believes the ultimate legacy will be how that U.S.-China dynamic has been reshaped and how that, in turn, forces other nations to kind of pick sides or position themselves.
Which then leads to a pretty critical question. Is China still a viable investment destination given the heightened risk of a more pronounced Cold War?
Right. And what's Napier's current take on investing in China?
What does he think?
Well, given the increasing risk of a significant decoupling, maybe even a full-blown Cold War scenario, he currently views China as largely uninvestable for international investors.
Uninvestable? Wow.
Yeah, he draws a parallel to the difficulties people had with Russian assets, like Sberbank, issues with international convertibility. He sees potential for Chinese assets to face similar challenges.
In Taiwan.
While Taiwan is often highlighted as the most likely immediate flashpoint, he cautions against trying to predict the exact timing or nature of any potential conflict. It's not that straightforward.
He then delves deeper into China's exchange rate policy and how that actually amplifies the risk of geopolitical conflict.
Yeah.
How does that work?
Napier explains that China's long-held policy of pegging its currency to the dollar, while it was great for their export growth initially, has now become increasingly problematic for China itself.
How so?
It's led to a loss of independent monetary policy control and a huge run-up in their debt-to-GDP ratio. He anticipates that China will eventually have to do something about these issues.
Like what?
Potentially a currency devaluation or maybe increased tariffs. actions which could have really profound disruptive effects on the global monetary system and potentially accelerate the formation of those two distinct economic and currency blocks he talked about.
And a significant devaluation of the Chinese currency could then force other nations in Asia to effectively choose sides.
Yes, he uses Malaysia as a potential example. A big drop in the RMB would likely put competitive pressure on other export-focused economies in the region.
Forcing them to devalue, too.
Potentially, yeah, forcing them to devalue their own currencies in response, which would align them more closely with the Chinese economic sphere. He does acknowledge the potential criticism of this being an Anglo-Saxon view, recognizing some Asian nations might see things differently regarding aligning with China.
Yeah.
But he reiterates that the exchange rate issue creates this dynamic that just increases the risk of geopolitical friction and miscalculation. He even suggests
Vietnam, not Taiwan.
could be a more immediate point of concern than Taiwan, given the ongoing tensions with China in the South China Sea and their shared border. He draws a parallel to the Cuban Missile Crisis high stakes, potential for miscalculation.
Okay. What about the ongoing Russia-Ukraine war? How significant is its resolution to this broader picture of global realignment that Napier is outlining? Does it change the trajectory?
Napier argues that while the human cost and geopolitical implications of the Ukraine war are obviously massive, its specific resolution is actually less critical to the major structural shifts he's focused on.
Really? How come?
He believes the U.S. pivot towards a more competitive stance with China was already well underway before the Ukraine conflict started, and it's likely to continue regardless of how that war eventually concludes. In his view, U.S. policy towards Ukraine is largely in service of this bigger strategic objective concerning China.
Got it. Finally, the conversation turns to Russell Napier's specific advice for navigating this pretty challenging investment landscape. What are his key recommendations for preserving wealth?
Well, his first piece of advice is pretty blunt. Don't try to actively trade in this environment.
Just don't trade.
Yeah, he emphasizes the really high levels of volatility that come with periods of structural change. It makes short-term trading incredibly difficult and unpredictable. The focus, he says, should be on long-term wealth preservation, not chasing short-term gains.
Which takes courage.
Exactly. It requires courage to adopt strategies that might seem contrarian right now. He also strongly advises against holding traditional government bonds.
No bonds. Why?
He argues we're likely entering a period where debt gets inflated away, which is historically a bear market for bonds. He thinks that bear market may have already started.
Okay, so avoid bonds, don't trade. What about where to hold assets and in what currencies?
He suggests considering jurisdictions that are less likely to impose capital controls. So, geographical diversification and being mindful of which countries might restrict capital outflows. He mentions Singapore as a potential example with fewer controls.
And specific assets to be wary of.
He expresses concern about highly liquid, widely held assets in scenarios where governments might force capital repatriation, specifically mentioning the S&P 500 and U.S. Treasury bonds.
Right. And when it comes to the types of companies and investment strategies to favor,
Yeah.
what should people look for?
He advises caution regarding the companies that have been the massive winners over the last 30 years. The current giants in indexes like the S&P 500.
Why caution there?
Historical trends suggest significant turnover at the top over similar long periods. Things change. Instead, he suggests looking towards value stocks.
Value investing.
Yeah, and investments in developed world companies that directly compete with China. He also stresses that what seems risky is relative. A portfolio tilted towards value, maybe holding some gold, might feel risky compared to recent norms, but could actually be wealth-preserving in this new context.
All right.
The key is avoiding risky quantities of any single asset.
Any thoughts on active versus passive investment management?
He recommends seeking out active managers who really focus on value investing rather than just momentum strategies.
Because the old momentum drivers might not work anymore.
Exactly. The factors that drove momentum in the past may not be the drivers of future returns. He also suggests maybe looking at smaller, less liquid companies with strong fundamentals that haven't seen the same kind of valuation distortions as the big, widely followed stocks.
And a fundamental shift in investment mindset is crucial here.
Absolutely. The shift should be away from constantly asking, which stock should I buy for a quick profit, towards a much longer-term perspective of which companies do I genuinely want to own as part of my portfolio?
Ownership over trading.
Right. He emphasizes the potential for increased dividend payouts from mature value-type companies during periods of financial repression, as dividends have historically been a big part of total returns then. He also suggests looking for value outside the U.S., as many international markets seem more attractively valued right now.
Anything else?
Yeah, a final caution. Beware of narratives of national exceptionalism. Every era seems to have them, he says, and they often turn out to be unreliable guides for investment decisions. History is littered with examples.
Okay, so to boil it all down, we're looking at a pretty significant shift away from the global order of the last 3 decades, a move towards a more nationalistic, potentially financially repressed environment.
Right, and understanding those underlying global imbalances is really key to grasping this transition.
And navigating it successfully for wealth preservation. It sounds like it will likely require a long-term, courageous, and very value-focused approach to investing.
Yeah, it's about adapting your whole understanding of risk and return to this new reality, and recognizing that the investment playbook that worked so well in the recent past, it might not be the most effective guide for the future.
If you want to explore these ideas further, Russell Napier's Library of Mistakes at libraryofmistakes.com sounds like a fantastic resource. It offers lectures, deep dives into financial history.
Yeah, and his podcast and the Solid Ground newsletter are there too. Lots to dig into.
Definitely. And for you, our listener, as you digest all of this, what are the assumptions you've held, maybe without even realizing it, about the global financial system, that these insights compel you to now reconsider? Something to think about.